Hello, it's Charlie and Kevin here, or AKA the Professor. So thanks for joining us. Thanks for coming out of the tax cave, Kevin, to hang out a little bit and discuss a few things today.
Yeah, I actually had to turn the lights on today, Charlie, just for the video. But yeah, it's
That's
good
right.
to be with you.
That's right. That's right. So today you and I talked, and actually you and I have been talking a lot this year, especially starting in February, about, man, this market is frustrating. And our clients are frustrated. We feel it too. You think, for me, Kevin, in January, I was like, oh, I think we're going to get past this. January was a good month. And then bam, February and parts of March, I think we've maybe had a decent week in the last week or so, but nonetheless, it's been a frustrating year and a half since November of 2021. And so it's exhausting. What do you think, Kevin? I mean, you feeling that?
Yeah, we talk about investments for the long run, and we talk about the long run, but inevitably, when you get frustrated with your job one day, or you get frustrated when you turn a certain age, you look at your accounts and it hadn't gone up since last year, maybe even 2 years now. It just becomes kind of like, are we doing the right thing? And then we hear so much bad news, Charlie,
Yeah.
that it's like, are we doing the right thing? So it is something that happens.
No. I know one thing that I feel, Kevin, our clients feel, and that is when I save money, I put my money in my 401k, and then it goes down. It's as if I didn't put any money in there at all, these last year or so. I know that I'm buying shares. I know I'm buying shares, but we feel that way, our clients feel that way, and it's tough. It takes a little bit of, I think perseverance might be a right word right now, but people, that's a tough one. Perseverance and discipline, right?
Yeah. So, I mean, 2022 was a bad year. So
Mm-hmm.
we come into 23, and a lot of people said, all right, this is going to be the year, as you said,
Yeah.
Charlie. And I received a number of calls in February, early March saying, now we have this banking crisis. Things look really bad.
Mm-hmm.
And we lost a lot of our gains for the year. And so I think sometimes it's not just the 1 year, but it starts to kind of grind on you
Yeah.
over time. And as you said, you keep putting your money in every 2 weeks or every month, and
Yeah.
doesn't seem to go anywhere. It can be very frustrating.
Yeah. The thing that you and I need to provide to ourselves as well as our clients and friends and families is the perspective. Is this normal? And I think the answer is yes. As much as people, I think that's hard to hear sometimes, Kevin. Here's my investing life, and you're just a smidge older than me, wiser and more handsome and such. But
Now
but
I
this is
know. Now I know you're. Go ahead.
this is my investing life, Kevin. I started in, I finally got a little bit of money from the military in about 98, 99 time frame. .com was raging. People were averaging 60% annual returns on their mutual funds. I didn't get that, Kevin. I started investing in 99 and it went down. So maybe that's my fault, but .com was when I started investing, .com bust. September 11th followed a couple of years later. 2008, 2007 housing crisis, great financial crisis, the biggest recession we've had since the Great Depression, wars in Iraq and Afghanistan, COVID-19, Russia, Ukraine, inflation, rising rates, the worst year for bonds ever, bank run. Anyway, so
Yeah. I'm
sounds
getting
terrible.
I'm getting depressed. I'm
Yeah.
getting depressed.
Mm-hmm.
So one of the things I often think about, and I've chatted with others about, is it seems the good old days were better.
Yeah.
There was maybe less to worry about in the good old days. And
Mm-hmm.
then when you go back and you look at some of the good old days, they weren't always good.
Yeah.
More disease, more poverty.
Mm-hmm.
The 50s had issues post-war. So every time period has
Mm-hmm.
been bad. I know people call all the time, Charlie, and they say, well, what about this? What about this? This is all terrible.
Yeah.
The truth is that we've had to endure and invest through a lot of negative time periods to become
Mm-hmm.
a good investor. So are you going
Absolutely.
to share any data?
Yeah, here goes. This is what it looked like when I first started investing. And, while I'm pulling this up, Kevin, one of our favorites, Ben Carlson, Common Sense blog, I think it's called, talked about it. And he loves financial history as I do. But he listed about a dozen books and said, read these books on financial history and you'll get a feel for how bad it has been in other times. And this is absolutely a normal time stretch for the markets. It's always going to be a different event. COVID-19, we can't possibly imagine something like that, or whatever. But the market, it's not abnormal. In fact, this is the beginning, that period I talked about, Kevin, where I started investing. I'll never forget, my father-in-law said, "Hey, just invest in the S&P 500, which is obviously a great investment. We know that." And so that's what I did as a young second lieutenant in the Air Force. And man, for 3 years, Kevin, I got nothing, a negative balance just about. And I was thinking, 3 years is an eternity when you first start investing. And we talk about perseverance and patience, but this is an eternity.
The reason why this sticks with you, Charlie, is you first started investing.
Mm-hmm.
So these time periods when you first start having enough money that it actually matters, that's another time when people can get hooked by negative or not positive returns.
Mm-hmm.
When people retire, they can get hit by it. When people start their financial planning career, they can get hit by it. I mean, my start was in 2008. And the stock market had been down for 10 years in a row. And people were saying, why should I throw good money after bad in 2008? So I think what are you going to draw up here?
Yeah, I just think that, 2008 was tough because it was so difficult, but it actually was a shorter time, as far as a stock market downturn. The early 2000s, this is all the way out, I think 4 years now we're getting close to, is still down. And now this became known as the lost decade. But let me just go out a little bit farther and just see what this looks like big picture wise, see if I can kind of share that. So now, again, people might say, "Hey, I'm not a long-term investor. I'm getting ready to retire. I'm older, whatever." But we're all long-term investors, regardless of whether we're in near retirement, because we have to outpace inflation. And this is our best chance. So this is the big picture, widening that lens for since 99 to 2023, basically present day.
Well, in mental accounting, Charlie, is something that's supposed to be a behavioral bias or behavioral finance. But in this case, I mean, anytime that you're invested in stocks, you have to have a mental accounting that the stock money is for 10 years. So even if you're retiring tomorrow, you want to consume other investments for the next 10 years. But again, it's very hard to see sideways returns or your money value going down. I don't care what type of an accountant you are, mental or otherwise. You ain't going to be able to stick with it unless you have some understanding of history.
That's right. Yeah, I love that mental accounting, because you can see that a certain account, it goes down. You're not going to touch that for a while, even if you're closer to retirement. If that account is separated, that's a whole nother discussion about the bucket retirement strategy. But there are 3 principles we want to leave people with, Kevin, today. And by the way, this is part 1. Part 2 we'll do next time. That's going to be, how do we think about investing? What do we do, and why do you and I have faith that the investment principles that we believe in work? So that's what we're going to cover in number 2. Number 3, part 3 is going to be, what can we all do as investors? It really is up to us. Our success is based on us, regardless of whether it feels like the world's falling apart around us or not. We have more control in the long term than we feel like we do sometimes. So those are the next parts. But Kevin, the 3 things we want to leave people with today, you got a good one there. That might be the 4th, the mental accounting part. But the second one there you kind of talked about or alluded to was just, being diversified. And you can't just have, like we showed, the S&P 500, even though it's done great in the last 10 years. Well, there was a long time period there where my investing life where it didn't do anything. Now, it's a good investment. We're not saying that, but we have to own other types of investments to be successful.
Yeah, Charlie, I would also just like to add in here that, many times financial planners have been guilty advisors of telling people what they should do. And not everybody has to play this game. There are certain people that after 3 or 4 years, 2 years, 1 year, they don't want to do this. And so there are other avenues to get returns and not play this game. But if you're going to play the game, that's when I think it's extremely important that you understand it is a long-term effort. And that's how you get the big returns, not by, getting in or out or changing your investment beliefs when you get frustrated.
That's right. And that leads to number 3. And I think I said we had 3 principles, but we got 4 now because of the mental accounting. But the third one there is that market timing it doesn't work. And when it does work, the few times anybody has seen that, it's you can't distinguish between luck. Did we get lucky? And so I think John Bogle of Vanguard said it best. I don't know anybody. I've never been able to market time. I don't know anyone that knows anyone else that's been able to market time successfully. And that's a pretty, a good resource there.
Yeah, market timing is really exciting when you sell, and then you can't figure out when to buy back. And then should you sell again? Should you buy back again? I mean, it just becomes a terrifying way to try to react to markets. But Charlie, the other thing that I think is extremely helpful for me, and this sounds like I'm coming across maybe a little too blunt, but I don't mean it that way. If markets go down in the next year, I think we all have to ask ourselves, so what? So what if markets go down the next year? Again, that mental accounting of saying when I'm investing in an equity, I'm going to wait at least 10 years. Now, does that mean I might not get a return in 2 years? No. But we have to say, well, so what? Because I'm going to be using this money in 10 years, and just constantly ask ourselves, hey, this bank failed. So what? How does this affect my 10-year time horizon? Not easy to do. I would never say that to a client who called and said, hey, my account value is down. But I think personally, we need to ask ourselves, so what is the events that are happening today?
Exactly right. I think we can say that confidently. And again, we're not trying to be disrespectful. So what? But really, you literally mean, like, does it really matter? And I think we can be confident in that question if we know that we have the right risk. Because those people in 98, 99, they got overconfident with the tech stocks. They were near retirement. And it did matter, to those people, because they were not diversified. They had the wrong risk. So if we have that plan, if we have a plan for our investing, we can say, hey, it doesn't matter to me in the short term. And that should be an opportunity to relax a little bit, to know that, you've got a plan and you're doing the right thing. So.
Yep. And if you're investing your money, today is a good day to invest. If the market goes down, it's even a better day to invest.
That's right.
As long as at the end, when you pull the money out, it's gone back up.
Absolutely.
That's the key. I
think it takes planning. And the last one is uncertainty is unavoidable. And we know that it's just something we're going to have to live with. I listed the events at the beginning of this video, Kevin, from 99 to 2000. It is going to be something different, an event, but the market will be the same. Maybe react the same is the right way to say that. It's going to have its ups and downs. There's going to be lots of uncertainty, and we have to put up with that as investors. And that's why there's an investment return to begin with. Otherwise, there'd be no returns to have, right?
Yeah. So I've been terribly afraid twice in my financial planning time frame. In 2008, 2009, I was terrified. And then again, during COVID, I was terrified. I really was. And, I think if you're not intellectually honest to say, yes, there's times you're going to be terrified and something else might cause terror within your life, but you have to have some fundamental trust that you believe that investing for the long run is going to work out for you. And again, don't put all of your eggs in that basket. Don't put 100% of your capital into equities if you're somebody who gets terrified easy.
That's right.
So I think that's really the key, Charlie, is to put enough money in equities that you're going to be able to eat well in retirement, and then put enough money in other places that you're going to be able to sleep well in retirement. That's right. Those to me are the key.
Absolutely. Yeah. I love it. I'll finish up with a quote here, but I love that you said you do, as an investor, you have to have a fundamental belief that the human race has enough ingenuity to solve problems, to add value. And that means there's going to be companies that make a profit. And that's really what we're investing in. But we'll talk about that next time in part 2 and 3. But I'll leave us with this quote from the Dimensional Fund Advisors. It says, when the unexpected happens, many investors feel like they should be doing something with their portfolios. Often headlines and pundits stoke these sentiments and predictions of more doom and gloom. For the long-term investor, however, planning for what can happen is far more powerful than trying to predict what will happen. So Kevin, thanks so much, man. And good talking to you as always. Thanks for your wisdom and knowledge. Now go back to the tax cave. We'll talk again soon.
Yep. Thanks, Charlie.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from these projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.